So let's talk about Baidu today. I believe for those of you who are interested or have already invested in the Chinese tech scene or Chinese equity space, you probably would have came across this company name already, Baidu. And if I were to take you back down memory lane, maybe in the start to mid 2010, you probably have came across this terminology called BAT, B-A-T. And it's basically the equivalent of the Magnificent Seven in the US stock market today, the three dragon head or the three leaders in the tech scene back in the 2010s, which is namely Baidu, Alibaba, and Tencent. So I think over the past decade, Baidu has slowly lost its mojo. So this term BAT is kind of still there, but Baidu has then been replaced to ByteDance, which is the parent company of TikTok that took the world by a storm in terms of short-form video content. And on another note, at least in the Chinese tech scene, there's this new terminology being created called ATM, and it's now replaced as Alibaba, Tencent, and Meituan, because three of them are all publicly listed company. But history aside, I think let's dive deeper into what are my thoughts around Baidu today and why do I not have a position in them. And I think through my own YouTube journey, you guys probably would already know that I have explicitly stated my biasness and why I'm bullish on both Alibaba and Tencent. And I've created quite a few videos, if I can say, on my entire investment thesis on why I think they are valuable opportunities in today's market. That said, I think I've been receiving a slew of comments from my viewer base asking me about my opinions on Baidu. And there you have it. Since you asked, I will probably deliver. So from John here, he asked, "Hello Chiking, have you ever considered Baidu? Considering their pro, which is their market share leadership in Gen AI, the amount of cash that they have versus their market cap, their leadership in robotaxi, and the downside is that their weakness in the ads legacy business model. And also, they're currently only 30 plus billion in market cap that have a long way to run versus Alibaba." Another comment from Buha asking me whether I'll consider doing an in-depth analysis on Baidu. And the last comment from Peter saying that he bought a few shares of Baidu, and personally he likes Baidu better than Alibaba. If there is a Chinese company that is another Google or Nvidia, I bet that it will be Baidu. So I think I just put together a very short presentation slides to discuss about this idea on whether Baidu will really be the next Google. And just a heads up, I think they're far from it. But let's get into the details. So another source of inspiration, the long investor, he recently has been quite vocal in terms of his Chinese position, and he did tweet out just 1 or 2 months back saying that the most undervalued position now from China is not Alibaba, but it is Baidu, the Chinese AI market leader. And he goes on to talk about the valuations again. And part 3, actually from one of the famous personality in Singapore as well. For those of you who don't know him, it's okay, but he do share a similar thought process in terms of his Baidu investment thesis. And it's a search platform similar to Google, and it has invested heavily to develop its AI software. So its price earnings ratio now is less than 12.5 times compared to 27 times for Google. And its highest price in January 2021 was $330 US. So its average cost was $100, and the price of Baidu has dropped by about 20% during the past few months. So the lowest price was 80, and the stock has started to recover a little bit. So his target price is 150, reflecting a price to earnings ratio of about 20 times. And I hope to see it reach this level within the next few months. There's quite a lot of people that follow him, and he garnered more than 2,200 reactions on Facebook. Here's the interesting thing. I want to take the chance to kind of break down the entire thesis and why I stand on the other side of this entire valuation argument. But before that, I think I just took the liberty to kind of consolidated a few of these leading tech names that most of you are probably aware of, and to try to kind of postulate where they can potentially recover back to their all-time high, because this is the context that was set by Mr. Tan here, where he was comparing it to the peak pricing of some of these names. And just a very big disclaimer here is that I think that this is a fairly inaccurate, or in fact, it's a grossly inaccurate way in trying to determine your investment. Just because a company is down X percentage from its all-time high does not mean that it will recover. Yes, you can talk about it from a technical analysis point of view or mean reversion perspective, because the market is a weighing machine in the long term. And I've listed here the top 8 so-called quote-unquote tech companies until Baidu. And this was their peak share price and the date that I've extracted the share price and their current price and what's their maximum drawdown. Despite all the narrative and story building, saying that China is uninvestable, you have the Trump and China trade war, whatever tensions that you have and capital fleeing out of the China market, actually Xiaomi and Trip.com is currently near their all-time high, or in fact, it is at their all-time high at the time of this recording. And I think if you do a quick comparison, you can see that most of them essentially peaked near Feb of 2021. Alibaba being the unique one that peaked a lot earlier. So looking in terms of the percentage drawdown, Baidu is ranked number 1. And I'm not too sure whether this is a good thing in terms of their ranking, but followed by Meituan and then Ali.
And since we're on the topic of historical valuations and price target, you can actually use Momo's platform to give you a quick overview for your own research. So you can essentially search for the company on the platform and you go until the company section and you get to see their upcoming earnings estimates and consensus analyst price targets here. Of course, please make sure that you do your own due diligence and don't just buy based on the consensus rating. So on top of that, you can also see the historical valuation range. And today, Baidu's 5-year percentile is less than 30%, probably signaling that they are on the lower side. So there are other functions you can check out on Momo as well for you to make a more informed decision, such as Morningstar's research. And they give you a very quick overview in terms of what both the bulls and the bears say. And if you want to view the full report, it's also made available on Momo's in-house platform.
So this is the context of where we sit at the Chinese tech drawdown today. But do you know what won't draw down with a 100% win rate? Welcome rewards from Momo. So you must celebrate the new year with Momo as they're offering Angbao deals worth up to 3,154 Singapore dollars. It's the perfect way to start 2025. So here's the deal. New users to Momo can now sign up for an account with my link below and you'll get 30 days zero commission for the Hong Kong stock market and lifetime commission free in the US market. On top of that, new users can get up to 1 free Tesla share and $20 worth of cash coupon, which is an affiliate exclusive if you use my link below. So for those without $100,000 in capital, to qualify for the highest tier of sign-up rewards, you can deposit at least a cumulative amount of 3,000 Singapore dollars, complete 3-buy trades, and maintain the assets for 30 days. And you'll get $20 in cash coupon plus an additional 0.1 Tesla shares, worth roughly 47 Singapore dollars. So that's $67 worth of rewards in 30 days, 2.2% of a 3,000 capital base. And for those of you who have created a Momo account before but have not made your first deposit yet, you are still eligible for this sign-up promotion. So all you have to do to get this special deal is to log into the app, search for a special deposit, and click Go, enter the promo code CK88, and make your first deposit. You'll then be able to enjoy the new user rewards mentioned earlier. Oh, and did I also mention that you can get an interest booster of up to 6.8% per annum for the first 30 days if you park your money with Momo Cash Plus. And I heard that this promotion is ending really soon. So for those of you who are still sitting on the fence, don't wait any longer. So this sign-up reward campaign will end on Valentine's Day, 14th of Feb 2025. It's the last call. Sign-up link will be in the description below, and thank you Momo for sponsoring this video. Now, let's dive a little bit deeper into understanding Baidu's core business and in terms of their numbers, how they've been keeping up. So I've essentially put out the last 20 years revenue growth chart of Baidu, and we are greeted with this fairly interesting distribution. You can see that in the earlier part of the first, 5 to 10 years, we are experiencing that sort of very steady growth rate that you would expect of a tech company as they're scaling up in the early 2010s, where basically the world is your oyster and there's a lot of room for growth and for them to sell a great story. However, if you take a closer look in terms of the past, 8 to 10 years, revenue seems to be kind of plateauing and we don't see that sort of good growth rate anymore. And just an important point to take note as well was that actually on the y-axis, they're not drawn by scale, meaning to say they are not scaled proportionally. They can jump from 280 to 750 million, that's roughly 400-500 million, and then the next jump is from 15 billion to 40 billion. And it presents quite clear a picture when you look at the compounded annual growth rate of the trailing 12-month 1 year. In the last 4 to 5 years, revenue is staying flat at 0.93% growth rate on a year-to-year basis. So I then took the liberty to macro trends to extract the revenue growth chart of Baidu, and we have confirmed our suspicion. You can see that over the first 5 to 10 years, you can really see that exponential growth rate. And over the last, 4 years, revenue is flat. In fact, they have achieved the peak revenue at roughly end 2021 or start of 2022. And if you compare it to their latest figures, they are experiencing some sort of a negative or flat revenue growth. And I've extracted from their most recent third quarter financial highlights. Their total revenue is actually down 3% year on year, and their operating income, both on a GAAP and non-GAAP basis, is down 6 to 8%. And here was their explanation. So Baidu's core flat top-line revenue growth reflected the ongoing weakness in their online marketing business, offset by the growth of their AI cloud business. So our strong AI capabilities are garnering broad market recognition, as evidenced by increasing adoption of ERNIE. In terms of their intelligent driving, Apollo Go also continues to lead the global autonomous ride-hailing market. Now, as a prospective or an existing Baidu investor, you are dealt with a mixed bag disclosure. So on the top line, you know that revenue growth rate is flattish. They're telling you that their core advertising business is weak. But that said, they try to mask or offset the impact, trying to cushion the blow by saying that, oh, don't worry, their AI cloud business is kind of experiencing some sort of a good growth that is offsetting that legacy ad business. On the other hand, Apollo Go, which is their autonomous ride-hailing market or business, is doing quite well as well. So how do you read or how do you assess this news? Let's try to investigate further. Now, digging deeper into Baidu's revenue breakdown, Baidu Core at 26.5 billion RMB out of 33.6, this roughly makes up 80%. So their core business, just remember, it's 80% of the business. Their online marketing revenue, it's at 18.8 billion. And this part is actually a shrinking or a decreasing business. So if you actually divide the 18.8 billion out of the core revenue, which is 26.5, the online marketing revenue makes up around 70% of the core revenue. But if you take the marketing side of the business, divided by the total revenue, that makes up of around 55%. So yes, you can see that Baidu is trying to sell this story very hard, saying that they are the AI cloud business or they are in the autonomous ride-hailing business, but their core marketing business still makes up more than 50%. In fact, it's 55-56%. There's still a long runway ahead for them to prove whether they can continuously bring in additional revenue from the other business arms. But as far as I'm concerned, they're still a marketing business at heart. And in fact, it's a failing marketing business because they are decreasing in terms of revenue. I'll explain a little bit more why I think it's a failing business. But that said, I think pivoting over to where they want your attention to be at, the non-online marketing revenue, it's up 12% year on year, mainly driven by their AI cloud business. Revenue from iQIYI, which is some sort of a streaming Netflix plus YouTube-ish kind of business, they are also shrinking. It's decreasing 10% year on year. Makes up the remaining part of the total revenue. So looking at this business, their core marketing business, 55%, it's decreasing at a 4% year on year. The other non-core part, which is iQIYI, it's decreasing at 10% year on year. So you can probably look at it from a glass half full or half empty point of view. Half full saying that, oh, we are very excited about where is to come or where Baidu will be positioned in this AI transition for the next decade. Half empty, you can think about it as it's really a deteriorating business with both their core and non-core revenue just decreasing year on year. And it signals quite strongly in terms of the competency of the management team when we do a cross comparison over other tech companies as well. So if it's a general, if China's economy is really doing very badly, all the tech companies are experiencing consistent negative growth rates, then sure, maybe you can say that there is some sort of a free pass for some of these tech companies. But clearly, I think when you extrapolate or try to triangulate with Alibaba, Tencent, they all have their flat quarters back in 2022, but they've all kind of resumed to decent growth rates already compared to a decreasing or shrinking business pie. The cost of revenue actually increased 1% year on year due to the increase in traffic acquisition costs and costs relating to AI cloud businesses. So just take it for whatever it's worth. I will pander to those that are fairly optimistic about Baidu and whether they are able to turn around the situation. So let's ignore the core marketing and ignore iQIYI. Let's think of them as the dead weight to the business and focus on where we see the most opportunities in the coming decade, which is namely the AI cloud and the intelligent driving part of the business. And here's what they have to disclose in their most recent earnings. They said that their ERNIE developer community actually grew to 18.1 million people. And in November of 2024, they handled approximately 1.5 billion API calls daily. And it's a significant jump from 600 million in August. And here, I guess we can make the simple conclusion that there is clear demand, there is important and growing exponential demand in this whole AI cloud space that could potentially be converted into revenue potentially in the future. But at least for now, I think even in the US tech scene, a lot of all these tech juggernauts have not really found a very clear-cut and profitable way into monetizing their AI offerings. So I look forward to how Baidu is going to do it, but at least for now, we are testing the demand and we can see that there's some sort of a demand. How we monetize it, let's put it at the back burner for now. On the second part, I'm talking about intelligent driving. Apollo Go actually provided 988,000 rides in the third quarter of 2024, and it's up 20% year over year. So as of October of 28th, the cumulative rides provided by Apollo Go surpassed 8 million. So during the third quarter, rides provided by their fully driverless vehicle accounted for 70% of the total rides nationwide. So they're basically just signaling or telling to investors that, hey, even China being a very competitive, large market, Apollo Go is clearly the front runner and the leader in this whole autonomous driving space. And their 6th gen autonomous vehicle RT6 is now also operating in public roads in multiple cities in China. So I think as a potential investor, I think it's cool to be greeted by such numbers. You tell me that you hit nearly 1 million rides in third quarter of 2024 and it's up 20% year on year. This looks fairly interesting. And at 8 million rides, I don't really know or appreciate this scale. I don't know, is it too many, too little? How do we understand this? And in fact, I just did a quick Google search. They told me that Apollo Go from Baidu started operating in 2019 and they have since expanded to 10 cities in China. And these are some of the key milestones. So from 2019 until October of 2024, that's give or take 4 to 5 years, and they clocked in roughly 8 million rides. So is that too many or too little? And of course, let's not forget that the context also matters, that in 2019, 2020, there is probably still a lot of skepticism and a lot of pushback. But recently, however, at least over the last 2 years or so, you can see that companies are stepping up their efforts, whether it's from Tesla or from Alphabet, which is the parent company of Google, with Waymo. So I just took a quick search in terms of what happened to Waymo and how much they've clocked. So Waymo told us that they served over 4 million fully autonomous rides in last year, or this year alone, which is in 2024. And you can see that this is the so-called S-curve or scaling laws that they are looking at. So in totality, they've accumulated roughly 5 million rides. And 4 million ride is done in just last year alone. And we can probably expect some sort of an exponential increase in 2025 or in the years to come. So really contrasting this, what Waymo has achieved and Apollo Go. So I'm not too sure by the end of this year whether Baidu can still retain their title of saying that the leading, or if not the leader, of the global autonomous vehicle fleet company. Moving over to the thesis for Baidu, I think there are two main theses that is quite easy to understand. Firstly, of course, it's this proclaimed AI leader in the Chinese tech space. They talk a lot about their autonomous vehicle and their AI cloud, but personally for myself, I'm not too sure about that. Yes, I think it's true. We have to give credit where credit is due. ERNIE bought by Baidu, they were the first to be released to the market. But I think subsequently, however, there were a lot more iterations coming out from the competitors, whether it's from Alibaba, from ByteDance, whoever it is. A lot of them are all trying to steal market share. And the hype kind of died down on ERNIE bot, and I don't necessarily hear them as much now. Yes, we can see the numbers of their API calls and the demand scaling up quite substantially. So the demand is there, but the supply has also scaled up exponentially with all the competitors offering a different take on this whole large language model, chatbot, whatever you name it. So we can't necessarily make the conclusion that it was because Baidu offered a superior product to its competitor, that's why it's growing at such a significant rate. In fact, it's clearly just an explosion in demand in that specific business unit, and Baidu is not monopolizing the demand. Funnily enough, even in today's context, we don't even know who is the AI leader in the US. And some of these are mega conglomerates with multiple trillions of dollars in market cap. And clearly, only one company managed to suck up most of the value in this AI gold rush. And it's reflected in their earnings, which is Nvidia. For the rest of them, I think they still kind of keep it hush-hush. It's not necessarily reflected in terms of their growth rates, and they don't kind of carve out a specific part of their earnings report. And I'm not too sure at this current juncture that we can stamp with approval. I'm saying that Baidu is the AI leader. So that's where I'm cautioning investors. Now, a lead up to this entire idea of why Baidu is called the AI leader is really because of multiple eye-catching or positive initiatives around the company. And I'll just name a few notable ones that I can recall at the top of my mind. So in March 2023, you have Ernie Bot being released, and they've reached 200 million users. But as I said, Kimi, a 12-month Alibaba-backed startup, quickly caught up based on some of this metric in terms of daily usage, APIs called, etc., etc. So Baidu might not necessarily be the only one in town offering such a service. In October 2023, they also announced a partnership with Geely to launch Jiyue 01, which is integrating Baidu's AI into an electric SUV, trying to rival that of Tesla's offering in the market. In November of 2024, we have quite a few notable achievements as well. You have Miaota, which is a no-code app builder. They also started into the forays of AI-integrated smart glasses, similar like what Meta is trying to do with their reality labs. And they also gotten their license to test out autonomous driving in Hong Kong. So all these, when you look at it on a standalone basis, looks like Baidu is really pushing the boundary and getting a lot of things done. But that's it. I think in the grander scheme of things, there's not much to show for. But the second thesis for Baidu, which probably attracted most of the current investor base, it's really the idea of their valuations today. And they're incredibly, phenomenally, unbelievably undervalued. And I've used 3 vocab for a specific reason. So if you look at Baidu's market cap today, so they're trading at an 11 times PE, 8 times forward PE, and they have a decent, in fact, they have a fortress of a balance sheet. So looking at their current assets and their long-term investments, I basically kind of took out their brand equity, goodwill, those kind of stuff. They're sitting at roughly $43 billion US dollars, and their current market cap, it's at $32 billion US dollars. So it's basically a net-net kind of situation where the price to book is clearly significantly discounted if you were to add in other non-current assets, which I have kind of left out here in my computation in the name of conservatism. So why do you think it's so unbelievable, or why do you think it's so undervalued? I think there's 2 points here. Number one, clearly it's the China discount. But funnily enough, I think some of these companies seem to be immune to this idea of a China discount. Secondly, it could potentially be a company-specific or a mismanagement discount. Meaning to say, you can see the balance sheet, you can see that they have this X amount of cash, but investors are basically bidding with their money, saying that they're expecting this money to be kind of mismanaged in a way. So the antithesis for Baidu is also quite evident. So in Mr. Tan's Meta or Facebook post, you can see that in the comments below, you have quite a lot of upvoted comments. So Baidu, mainly used in China with a very small coverage. Google is used almost everywhere. So your comparison doesn't make sense. Maybe you can make some money now, but long term, still US company. Baidu is horrible as a search engine. That's why there are other alternatives where the Chinese people are actively using now. So can China withstand Trump trade war? I think it's hard. So it's not wise to invest in China stocks. My suggestion is to don't waste time with China stocks, considering the trade war. And low PE can also mean that the stock is less popular amongst investors. So you can see that there are 2 specific genres of the antithesis for Baidu. One is more on a fundamental perspective, where they talk mainly about their search business, not so much about the AI and Apollo Go and autonomous driving and AI cloud. And on the second part is more so a macro pushback, talking about the US-China trade war and tension. So personally for myself, I don't think Baidu is deserving of the title of being the Google of China. And I think there is some misconception, especially when you think of it from an outsider point of view, and you draw or extrapolate some of this data point, and you form your own opinion based on the extrapolation of your own daily habits. And let me explain myself. So the nuance here that some of you might want to consider is that I think the daily habits of the layman, searching or punching a query into the search box, have a very different connotation when you compare it to the rest of the world. So for the rest of us, I mean, if you look at our habits in terms of what we search for, there are 2 main platforms, right? Firstly, it's of course things like your Google search, and then now you have ChatGPT and all your LLMs and stuff like that. On the second part is when you go onto social media and it's more social in nature, where you don't necessarily look for or key in your searches in some of these social media platforms. And when you look at some market share data from an outsider point of view, when you want to invest into Baidu, I just put out a very simple market share graph. You can see that, even in the most recent years, Baidu actually had around roughly 55% market share, and the next one is Bing at 30%. And you might think that, it's not too bad. I think Baidu still commands a majority of that search pie. So what's the issue here? But the danger lies in how they define search engine and searches. So at least based on my own personal reflection and my own lived experiences in China and just looking at how the entire landscape is evolving, a lot of people doing searches on social media platforms like WeChat, Kuaishou, Douyin, which is ByteDance or TikTok, and Xiaohongshu, stuff like that. And clearly you don't see all these social media platforms coming into this pie chart. So this pie chart, or at least this research, is being done in a very narrowed and, in my opinion, a very myopic view. And as you see that the general population all moving their habits or search functions onto some of these social media platforms, that is all the eyeballs and attention that you are not capturing. Compared to the rest of the world, where a lot of us do our searches on Google, for example, and Google being the dominant one with close to 90% or more than 90% market share. So that's why I think that looking at such data might be a little bit disingenuous and doesn't tell you the full picture. Because this search definition is very iffy. And I can tell you that, at least based on how I look at the consumer patterns there, everybody really searches things on the social media platforms. And Baidu, I think, is kind of reserved for more academic and more business-related users. And that, in and of itself, is a very small part. And roughly 10 years ago, in 2015, Baidu actually commanded 80% market share, and they're slowly dwindling downwards. So take it for whatever it's worth, but I do think that there's some sort of a execution mismanagement, and they clearly are not doing it well enough when you take into account the dominant nature of a search engine market, which I kind of hinted is the weak management and execution. So they dominated the search business in early days, but could not iterate and adapt quick enough in the highly competitive landscape. And a large part of these search queries have kind of been lost to the social media platforms. And I think just to cite a few of these so-called quote-unquote high-profile failures is that they failed in building Qunar, which is a travel-related booking site. I didn't spell site correctly. A travel booking site which was ultimately sold to Trip.com, and Trip.com has went on to become a much larger company which is appreciated by investors compared to Baidu. Secondly, they also failed the long-form video spin-off, which is iQIYI, and they did not manage to take off. Lastly, in terms of the Baidu Maps, which is the Gmaps equivalent, you can kind of intuitively think that actually what Baidu has to do is to just copy Google's playbook. But clearly they even lost the superior position of Baidu Map, and it's overtaken by Alibaba's Gaote Maps, competed and eaten away by the competitors. There's clearly signs of wrong steps taken by the management team. So I don't know much about the AI upgrade that we are talking about across their different business units, but I do believe that time will tell. So they need to sell this growth story extremely badly, and it has to show in their numbers. Unless they're able to kind of pull off a Tesla 2.0. But that's a topic for another day. So in terms of their ad model, you can see that they have a shrinking ad business. But interestingly enough, competitors like Tencent, Kuaishou, they're still growing their ad business amidst this context. So it's not necessarily a macro or a industry-related problem, but a Baidu-related problem. And valuations indeed do look really attractive today, but they have been slow in terms of rewarding shareholders with weak capital allocation and non-existent buyback decisions. Yes, you can say that a large part of their cash is sitting on their balance sheet, but if they're not buying back shares, unlike Tencent and Baba, then I'm not too sure how credible they are in terms of being aligned with shareholders in general. So here's my simple conclusion. I think I'm skeptical, but I can see a potential valuation rebound for those of you interested in playing the mean reversion due to the crazy valuations that they're currently sitting at. But I don't think that it's a compounder unless they're able to turn around the situation and find a new way forward. So I won't say it's impossible, but I'm not very interested in taking that bet for now, unless there are further developments. So going from the current 11 times or 8 times forward PE to 12 times or 15 times multiple versus going back to the 20 or 25 times multiple really depends on the state of the company's fundamental developments. But looking at their current 0% growth rate, I do find it hard to envision a time where investors are willing to pay up a 20 times multiple. Unless they are able to sell their recovery story and they can rebrand themselves as Tesla 2.0 with a great optimistic future ahead. So with that in mind, do feel free to leave in the comment section down below on what you think of Baidu today. And I'll see you guys in the next video. But more importantly, and hopefully, I'll see you guys on the moon. Goodbye.